Hello and welcome. My name is Eric Wilson from Freedom Venture Investments, and today I'm going to recap our 2024 Multifamily Market Outlook Webinar. But before I do that, I'm just going to jump in and give you a quick overview of why we do market analysis in the first place. Market analysis is an essential tool whether you're investing as a GP or an LP. It's a tool to evaluate the economic, demographic, and property factors of a potential investment. And the big thing that we're trying to answer when we're looking at market analysis is really three questions: if, where, and what. If is just, is this the right time to invest at all? Is the current market cycle conducive to making a profitable investment? Is there capital available for this investment? And if the answer is no to those questions, then we stop right there. But if the answer is yes, then it comes down to where. Where is the best location to invest? Looking at both regional and local market conditions. And then we dive into the local neighborhood supply and demand dynamics. Once we have a good idea of what's going on in the market and where we want to invest into, then we have to decide what type of real estate product we actually want to invest in, considering options like multifamily, office, industrial, retail, and then taking a step further and trying to figure out what's going to be successful in our target market. Is it an affordable product in demand, workforce, or does the luxury market make sense for what we want to accomplish? Those are all the driving questions that we were asking ourselves during this market analysis process. And you have to remember that real estate is and always has been a local investment. Different regions and different property types can be in various phases of the real estate cycle. So you really have to take into consideration what's happening at the national level, understand that the headlines, though, are potentially misleading, and you really have to dive into what's happening in each individual market because it could vary significantly from market to market. Now we're going to talk about what happened in 2023 to get us where we are here in 2024. In order to make good assumptions about the 2024 market and make educated guesses about where we want to focus our efforts in 2024 to identify the most profitable investments, we have to look back at what's been happening, look at the local trends, and use that to make inferences on where we would most likely want to concentrate our efforts. And doing that, if you rewind the clock a little bit and think back to the beginning of 2023, we actually started the year with some optimism. The US 10-year Treasury was starting to decrease a little bit, and that was, short-lived. We all know that it rebounded quite heavily. But if we think back to March of last year, the first big impact that we had in 2023 was the historic bank failures of Silicon Valley Bank and First Republic. And those bank failures really dried up a lot of the lender capital. It actually kicked off the plummeting transaction volumes that we saw in 2023, and this we're still feeling the effects of the regional bankers restricting their lending capacity even now. The next biggest impact that we saw was the Fed's focus on inflation. Their continued fight against inflation. We all know they've been hiking rates, but this really was the biggest driving force that really disrupted the capital markets. A lot of the pro formas that were created in 2020, 2021, and early 2022 really didn't anticipate that the Fed was going to be hiking interest rates the way that they did. So a lot of those projects that are coming out now, we might be seeing some opportunities, and we'll talk a little bit more about how that's going to impact our investment strategy going forward. The next biggest impact that we saw in 2023 was the political and geopolitical instability. Now, we avoided a government shutdown back in November, but that same issue is going to resurface here very soon. And then we have the Ukraine conflict that is now going on 2 years old that impacts things from material pricing and energy pricing. And then the events of October 7th in Israel, tragic, horrific events causing to additional economic instability and economic uncertainty. We actually had, looking back, quite a resilient year as far as the economy is concerned in 2023. At the beginning of the year, 7 out of 10 Bloomberg economists were predicting a recession during 2023, and we actually avoided a serious recession in 2023, showing a remarkable resilience. In my opinion, a lot of that is contributed to some congressional spending that we saw. We saw the infrastructure and semiconductor bill pass. So we did see a lot of spending. We saw a lot of funds flowing throughout the economy. And we also had the Fed hiking interest rates. So we had these two forces that were really combating at each other, creating a really interesting economy in 2023. So I don't think that, we were necessarily wrong about having a recession in 2023. I think we were just perhaps a little bit early, and we might see that recession pop up as a mild recession in late 2024, perhaps deepening into a bit of a more severe recession in 2025. Multifamily rents, we saw a lot of regional variations. As a whole, if we look at the median rent, we saw some negative rent growth, but particularly in the West and the South regions where we saw a lot of new supply hitting the markets after these markets have seen double-digit rent growth for the past couple of years in 2021 and 2022. It really was unstable. So when a lot of supply is hitting the market all at once, that demand isn't going to keep up with that level of supply hitting the market, especially after these massive years of rental growth. So seeing a natural correction actually makes a lot of sense. We actually predicted negative rent growth in a lot of our target markets at the beginning of the year, and that materialized in some of them. Not all. Some of our target markets actually did surprisingly well, but we were underwriting to negative rent growth this year for those reasons. And as I said, a big contributing factor to this trend was the high number of new apartment units delivered in 2023. Now, because of the bank failures and the interest rate hikes and the economic environment that we found ourselves in 2023, a lot of new developments that were supposed to start in 2023 were put on hold. So we'll see that that cycle of being in a housing shortage is going to continue, but that doesn't mean we won't see these supply shocks hit the market in little sub pockets of the country like we saw in 2023. And here's showing that double-digit rent growth that we saw back in 21, 22. And that's an unstable rent growth. So it's only natural that we would come back down into a much more healthy normalization. And we believe that we'll see a lot of our target markets normalize in that 2 to 4% healthy rent growth range by the end of 2024. Inflation was again a big topic in 2023. Throughout 2023, we saw a significant decrease in inflation, um, decreasing from the previous year's high of over 9% CPI reading back in June of 2022 to 3.35 in December of this past year. And wage inflation is in the labor market continues to be tight. This is a continued trend that we've seen. So as the Fed is combating the CPI numbers, trying to get down to its target 2%, it's also dealing with a tight labor market, and that's a sticking point for the Fed that they're really keeping a really close eye on right now. As you can see, private industry wages and salaries rose 4.5% over fiscal 2023. That's a bit of a double-edged sword for multifamily investors because it's great to see our tenants and our residents being able to afford more for their rent and be able to make their rental payments. At the same time, our operating costs are increasing. So between those two triggers, it's better to have our tenants be able to pay, but it does increase our operating costs at the same time. As you can see here, labor market's still very strong, but it is loosening, and we're starting to see that in the market today. Fed funds rate has been increasing steadily with their interest rate hikes, ending the year between 5.25% to the 5.5 target range. Again, reflecting that aggressive monetary tightening by the Fed. And a trickle-down effect of that, the Fed doesn't impact mortgage rates directly, but it impacts short-term yields, and throughout the yield curve, that does impact the 30-year, particularly with the US 10-year Treasury. That does ultimately impact the longer dated loans, such as the 30-year fixed rate mortgage, which climbed to over 8%, marking a significant impact in borrowing costs and affordability in the housing market. And this is probably the most substantial graph that we'll show today, but this shows the spread between the current cost to rent versus the current home mortgage payment. So right now it's arguably the worst time in history to buy a home versus renting, which is, it's that strong fundamentals for the rental market. A lot of our would-be home buyers are deciding to continue renting, and a lot of those are even the higher income earners are deciding to rent over purchase a new home at this time. Cap rates has been a major discussion. We've been talking about cap rate expansion since 2022. In 2023, we observed a notable increase in multifamily cap rates, with the national average reaching 5.2% by Q3. This was a significant shift from 2022 averages of around 4.25%, and in 2021, those ranges were between 3.3 to 3.5%. A lot of this was driven by the borrowing costs outpacing them, creating a certain area of negative leverage in certain deals. So a lot of buyers and sellers were on very different pages, and that creates kind of a holding pattern in the market. Again, with the availability of capital, we saw transaction volumes plummet, and a lot of buyers were sitting on the sidelines, not willing to take on negative leverage. I pulled up this chart because it's kind of interesting to see the historical perspective on cap rates. There's a common understanding that there's a relationship between the US 10-year Treasury and cap rates in the market. And the basic argument for this is if I can get a 3% yield on the US Treasury, which is considered the risk-free rate, then between that and commercial real estate, I'm going to want a premium on commercial real estate of maybe 150 to 250 basis points for taking on that additional risk. So I'm not going to buy something at a 3 cap if the 10-year Treasury is yielding 3%. I'm going to be looking at something more in the 4.5, maybe 5 cap range. So that's the general understanding. But I put this note here, correlation does not mean causation. There is a loose correlation between cap rates and 10-year Treasury yield, but I would argue that there is a much more closely related relationship between the availability of funds, and that actually drives cap rates. And there's a great article on the Linman letter from the fall 2020 issue that I recommend everyone read, and I will link below. In 2023, we started to see some signs of distress popping up. Different investment properties that were bought in 2021 and 2022 were overpaid and over leveraged with floating rate loans. And at the same time, rental growth rate has retreated. So that doesn't create a good scenario for people that bought those properties. We were fortunate as investors that a lot of the properties that we did buy in 2021 were bought all cash. So we were not over leveraged at all. Some of those investment plans included a refinance, and we had to change our business plan to just hold on to them all cash. But that kept us in a safe position as far as this distress scenario that other investors are seeing. And the next kind of big thing that we're seeing right now is a record number of commercial mortgage-backed securities will be coming due, and over-leveraged investors that are trying to refinance are going to find that their deals no longer work at today's higher mortgage rates. So for us as investors, for those of you listening, this is an opportunity for us. So investors with the capital to invest and the capability to navigate the distressed market, we can find exceptional opportunities. So we're watching this very closely to see what sort of opportunities can come out of this. This is again showing that wall of maturities that is coming by, and a lot of these maturities are loans that were acquired at ultra low interest rates, and they're looking to refinance in a completely different environment than what was on their pro formas. Preferred equity became a massive buzzword in the industry. I'd say the big two buzzwords were preferred equity and private credit. That was a big shift in 2023. A lot of lending shops and private equity groups started investing in preferred equity. Groups that had never done preferred equity before were all of a sudden labeling themselves as preferred equity shops. And we weren't immune to that as well. We made some preferred equity investments, and that isn't our typical MO, but that's where we were finding the best risk-adjusted returns. So when we did make investments in 2023, we made a few into some ground-up development deals as a preferred equity investor. Like I said, we invested in a lot of ground-up new development projects, and that continues with the strategy that we've employed since 2021, where we have really avoided existing acquisitions because we didn't want to buy things that were trading too far above replacement cost. So we've been really focused on our new construction strategy, both projects that we are conducting and investments with other developers. So this is a strategy that we will see to continue because we are investing for the long term. Build for rent again saw its continued boom. There was a little bit of a pullback in 2023, like we saw across the board with development, but build for rent still seems to be a very attractive option. It's anyone that's been following us for a while knows that we're heavily invested in build for rent. It's an asset class that we believe in strongly over the next decade. But the construction rate for BFR homes increased by 50% from 2018 to 2022. And despite a slight slowdown in 2023 due to oversupply and housing starts falling, the segment is expected to rebound strongly in 2024 and in 2025. For those of you that don't know what build for rent is, this is the slide that we use in a lot of our different presentations to introduce build for rent. It's a single contiguous community with single family homes, all built from the ground up for the specific purpose of renting to tenants. And you can see in the lower right-hand corner, you can have a wide variation of this product from horizontal multifamily, two-story townhomes, luxury single family, and traditional single family. Just like any other product in the market, it can come in a lot of different flavors, targeting a different renter profile. But this is a very attractive asset class, and it's one that institutions are very interested in, as shown by the recent uh, investment by Blackstone to take Tricon private. Again, the multifamily fundamentals, in our view, stayed very strong. Even though we saw the negative growth rates in 2023, those rental rates are still $250 higher than they were 3 years ago. So we saw this massive boom, again, the double digits in 2021, 2022, and even with the negative rates, growth rate that we saw in 2023, it's still higher than it was 3 years ago. So it's still continuing its upward trajectory. And we see over the long term, those rents normalizing into a much healthier growth rate that is much more sustainable. And that is fueled by the national undersupply of housing. And that lower number of starts in 2023 from the banking turmoil to the higher rates, that's gonna continue to solve that oversupply issue that we saw in certain markets, and apartment demand and rent growth will catch up based on the economics of each market. This is showing that we saw the fifth consecutive month of U.S. rents falling in December of 2023, but again, still $250 higher than it was 3 years ago. And that multifamily supply, this was projected earlier on in the year for supply to peak in 2024 and then leveling out to a much more sustainable level. Once we have seen the buildup of new construction come back into the market. Looking ahead, these are some hopeful outcomes. So that we talked about our biggest impacts, we talked about what's happened. Now we're going to be looking forward and saying what would we hope to see in the market in 2024. And these may not happen. These are just hopeful outcomes. And our first hope is that we would like to see a continued decline in 10-year Treasury. This metric really has the greatest impact on commercial real estate, and we would like to see that go down a little bit. It doesn't hurt our business plans if it doesn't. But that'd be a hopeful outcome for us if it did. Banking stability, some of the regulations that we saw, similar to some of the banking regulations that we saw after the GFC, are going to take place for regional banks in 2024. And we think that this will hopefully spur up some more lending activity after contributing to that banking stability. And then reshoring domestic supply chains. This is a long 10-year hope for us, but the pandemic really exposed a lot of the weaknesses in our domestic supply chains. And in 2024 and the years following, we're putting a lot of effort as a country towards reshoring these domestic supply chains. And we hope that we start to see some of that in 2024. It's not going to be an immediate change in pricing, but for the long term, this is going to hopefully create some price declines and again, just some more stability in our supply chains. These are all of our 2024 market predictions. So, the Fed gave us very mixed messages in December at their meeting about whether rate hikes were done, whether we might see some rate cuts, or if continued rate hikes are still on the table. I think we're going to see, depending on what sort of data comes out, they'll give us some more insight soon here. But we expect the 10-year Treasury yield to remain pretty high, 3.5 to 4.5%. And I talked earlier, I don't think that we were wrong about a recession possibility. I just think in 2024, in 2023, we were a little bit early, and we will see that recession pop up as a mild recession in late 24 and then deepening into 2025. The strong multifamily fundamentals will continue. And this comes down to that massive housing shortage that we are still seeing. So even though we might see temporary supply shocks from a lot of building all at once in certain markets, as a nation as a whole, we are in a supply deficit, and that contributes to strong fundamentals for multifamily, and a reason that we're pretty bullish on the entire asset class for at least the next decade. Slowdown development. This again is contributed by the banking turmoil, the tightening of the availability of capital, and the increased rates. This is going to dampen a lot of the skinnier deals that are out in the market. People are really going to only move forward if those development projects have a good amount of meat on the bone. So expect to see a slowdown in development as we saw towards the end of 23. We've seen multifamily asset prices decrease anywhere from 20 to 30%, really, and I would expect to see another 10% decline. I don't think that we've reached the bottom in valuations. I think we will begin to see some of that in 2024. Again, due to stagnant rent growth and rising expenses and less transaction volume, we might see transaction volume pick up, and we might get some more solidity on where these valuations stand. And then rent growth, we expect it to stabilize in that 2 to 4% range by the end of 2024. A lot of the markets that saw that negative rent growth will get to a much more healthier level by the end of 2024. And this is one that we're looking at really is finding potential opportunities in distressed multifamily. We're watching delinquency rates. We're watching those CMBS products. We're watching the loan maturities. We're trying to position ourselves so that we can get some potential discounts on properties that we've been looking at for several years. I think we're going to see some potential home price corrections due to these high interest rates and insurance costs. That's definitely on the table. Insurance rates are going to continue to impact property ownership and management, but I think that's going to be a continued issue. We are seeing some interesting products, especially in the Florida market, but high insurance rates is certainly a problem, and it's going to continue to impact the industry. And then anytime there's, some stirring in the industry like this, we're going to see industry consolidation. Larger firms acquiring portfolios from smaller entities. That's definitely on the table, and I expect that we will see that a good amount of that in 2024. This is the Fed funds rate versus that CPI index that we've been watching. You can see that as the fight against inflation has gone on, the Fed has increased rates. Looking at this chart, it looks like it's been pretty successful. So the question has been for 2023, and it still is that soft landing achievable? Who knows? But it looks like, looking at this chart, that the Fed has used that blunt instrument, which is really their only tool of raising interest rates, and it has been effective at decreasing the CPI. This chart is one of our most reliable charts for predicting a recessionary period for commercial real estate. And this is the delinquency rate on loans secured by real estate. You can go back and look at this chart on the Fed's website. As delinquencies rose, 26, 27, 28, 2006, 2007, 2008, we see the recession of the GFC goes down. We saw a slight uptick in 2020, and here now in 2023, we are seeing a slight uptick, still very low considering everything that's going on, but we are watching this very closely as we are starting to see delinquencies tick up. And the fundamentals, they are still strong. This is the biggest spread that we've seen between renting and buying a home. Home is, like I said, it's arguably the worst time to purchase a home, and it's because of this chart right here. The cost of home ownership right now is through the roof. We'll continue to see this slowdown. We saw it in 2023. I think this is going to carry into the beginning of 2024 until something changes. The skinnier deals are going to be put on pause until for the foreseeable future. And these are some of our target markets. This is not all the markets that we target. We don't invest in all of these markets either, but these are definitely markets that we watch. These are markets that we watch very closely, and these are the expected ranges that we think we'll see rental rates by 2024 and also going into 2025. So you can see we're actually seeing pretty much all of these markets on an upward trajectory between this year and next year. This is that same wall of maturities broken out, but this chart shows when the loans were actually originated. So you can see a lot of these loans were part of that pandemic liquidity bubble in 2020 and 2021. And a lot of those floating rate mortgages that are coming due in 2024 and 2025 will certainly create opportunities for other investment firms to step into those projects. Why we remain optimistic about multifamily? This is a core part of our thesis, but housing is an essential asset. We've had an undersupply problem since the Great Recession. Even though we saw a lot of supply hitting the market in 2023, doesn't even come close to hitting the supply needs, meeting the demand that's in the market. We're currently facing that supply. Between 5.5 and 6.8 million units are currently needed. We need to build 4.43 more apartments by 2035 to meet demand, according to the National Multifamily Housing Council. And this is a problem that's growing. It's going to continue to grow. And this is one of the reasons that we like build for rent products. We don't like to build things and then sell them immediately. We like to hold on to them for a bit. So that way we're not as dependent on the market dynamics. If we were coming out of the ground with a lot of our projects and looking to sell in 2023 or 2024, that wouldn't be a great place for our business plan to be. We like to have flexibility to hold these things for 3, 4, 5+ years minimum, and that gives us a lot more flexibility to time the market when we want to exit these projects. But we know that there's a demand for the things that we're building and the things that we're investing in. And the world is uncertain, but it remains a mistake to stay out of the market, and this will continue to be true in 2024. Looking ahead, this is the area that we're going to be focusing our investment strategy. And this is where I would tell people to focus their attention and be looking at operators like us and other operators in the market. Look for distressed assets, senior debt opportunities, and also preferred equity investments. Capitalize on this housing undersupply if you have a long-term growth perspective in mind. Build for rent assets is a great way to capitalize on that. But employ market research, diversification, and utilize the expertise that's in the market to make these strategic investments. And the ultimate conclusion is that regardless of the challenges that we saw in 2023 and even some of the potential challenges that we're seeing looking ahead, the multifamily market presents a substantial opportunity for growth and profit. It's been resilient. It's shown that it's resilient. We know that there's an undersupply. There's strong fundamentals. So looking ahead, we believe that it's a great place to focus our effort. And we hope that you found all of this information useful. And I'd love to hear your comments. Leave them below and let us know if you would like to see more of this type of content.